Okay, let's talk about accounting for receivables, Chapter 7. So what is an account receivable? Well, anytime you sell on credit where you're not receiving cash immediately upon providing a good or service, you're going to record the amount of revenue earned as an accounts receivable, a corresponding accounts receivable. And most companies, when they're doing business with other businesses, when they're selling to other businesses, sell on credit. It's what makes the commercial world go round. And so, up till now, you've seen accounts receivable as one big amount on the balance sheet, but when you actually record a particular accounts receivable, the only way you can keep track of it is to have separate sub-accounts receivable accounts for each customer. And so you've got your controlling ledger account called accounts receivable, and what you're going to have is subledger accounts of each customer's accounts receivable. So you're going to have ABC to XYZ company subledgers, and the sum of all your subledger accounts will be the total sum of your control account in the general ledger for accounts receivable. And so, again, this is how it looks when you record your accounts receivable. The second entry is what it looks like when you receive cash. You record the cash as a debit, and you, of course, are going to take the receivable off the books by crediting it. And again, here you have your general ledger. You're going to have your accounts receivable amount in there, and then you're going to have your various subledger accounts. Here you've got two subledger accounts, one for RDA Electronics and the other customer is Comp Store. All right. Let's see. I think we want to move on here. Don't really want to talk about store credit cards and bank credit cards or sales on installments. So let's move on to dealing with write-offs of bad debts. There's two ways to do this. When you sell to a customer and that customer doesn't pay you, you sell to them on credit and they don't pay you. One's called the direct write-off method, and the direct write-off method would only be used when you don't have a lot of sales on credit. If you have a lot of sales on credit, you can't use the direct write-off method. The book says you can't use the direct write-off method if your results would be different if you used what we call the reserve method. But for companies that have a lot of credit sales, just know that the direct write-off method is not per GAAP standards, GAAP principles. But if you didn't have a lot of credit sales, thus you're not going to have a lot of write-offs, this is how you would do it. You would simply, at the time you determine that a receivable is not collectible, you would simply debit bad debt expense, and your credit would be to accounts receivable, and this would be the subledger account for this particular customer that didn't pay you. In this case, it's J. Kent. Now, what happens if after you've written it off, you subsequently receive payment from this customer? Well, you've got to reverse the entry you just made. And so you put the receivables back on your books by debiting accounts receivable for this particular account, and you credit bad debt expense. And then you have to go through and record the receipt of the cash by debiting cash and crediting the customer's accounts receivable. Well, if you recall, the matching principle requires us to match an expense with the revenues that it's related to. And sometimes this is easy, oftentimes it's not easy. And again, if you have a substantial amount of credit sales, you're required to use the reserve method, and so you've got to somehow figure out the amount of bad debt write-offs you're going to have in a particular year. And so what will happen is at the end of the year, you'll have a certain amount of accounts receivable that have not been collected yet. And the year-end accounts receivable are the sales you've made for that year but not collected. And so what you have to do is figure out of that outstanding accounts receivable balance, how much of that will you not collect? And that's going to be your bad debt expense. And note that the direct write-off method usually does not best match sales and expenses. The only time it does is when you don't have a lot of credit sales. All right, so let's look at the allowance method, which is GAAP. And so again, you're going to estimate the total bad debt expected to be realized at the end of that period for the accounts receivable that still remains uncollected at the end of that period for the sales that you made during that period but haven't collected. So they're still on the books at the end of the year. Two advantages of the allowance method: it records estimated bad debt expense in the period when the related sales are recorded. So you've got your matching principle being met. It also reports accounts receivable on the balance sheet at the estimated amount of cash to be collected. So that's what's called the net realizable value. So here's an example of the allowance method and how you would record that. So TechCom has credit sales of $300,000 during the first year of operations. At the end of the first year, $20,000 of credit sales remain uncollected. Based on the experience of similar businesses, TechCom estimates that $1,500 of its accounts receivable would be uncollectible. And so the proper journal entry is going to be debit bad debt expense and credit a new account called allowance for doubtful accounts. Well, what is allowance for doubtful accounts? Well, it's a contra asset account. The asset that it's related to is accounts receivable. And on the balance sheet, what you're going to have is, in the case of this particular company, you're going to have accounts receivable at the end of the year of $20,000, and under it they're going to have less allowance for doubtful accounts, or they might just net the two, and what they're going to have is a net realizable value of the accounts receivable being $18,500. And so that's what that looks like here, showing the two ways you could do this. Either way is acceptable. And so note here the journal entry that would be made, and this is the same example that was used in the direct write-off method. Using the allowance method, you would not debit bad debt expense as you did with the direct write-off method, because you've already made the expense at the end of the prior year. And so the proper account to debit is the contra asset account, allowance for doubtful accounts. And so you debit allowance for doubtful accounts and then credit the particular subledger accounts receivable account. And note here that the write-off doesn't affect the realizable value of accounts receivable. Both accounts receivable as well as the allowance for doubtful accounts account go down after you write off this $520, but the realizable value of accounts receivable remains the same. Now, again, if you subsequently recover the accounts receivable after you've written it off, you have to reverse the entry you made, and so you debit the accounts receivable subledger account and credit the allowance for doubtful accounts account, and then the second part of this entry would be to recognize the cash received and thus removing the accounts receivable. There's a couple of different ways. There's actually three that the book uses or shows. Three different ways to estimate uncollectible using the second method. The allowance method. So let's look at those. It says here 2 methods, but there's actually 3 methods here. The first method is called the percent of sales method. And if you decide, and again, management has flexibility here, they can do this however they think is best, use the method that they think is appropriate. And so if they think that the percentage of sales method is appropriate for estimating bad debt expense, what they would do is at the end of the year, determine the amount of accounts receivable that they believe would not be collected, and they would do this on a percentage basis of that ending receivable. Oh, I'm sorry, that's the accounts receivable method, or yeah, percentage of accounts receivable method. All right, for percentage of sales method, you would just take the sales for the year and determine how much of those sales, usually based upon some past history of bad debt write-offs related to sales. And whatever that percentage is, you simply multiply that times the current year's sales. And that would be your bad debt expense, and you simply debit bad debt expense and credit allowance for doubtful accounts account. So let's see that. We have this company has credit sales of $400,000. They estimate that 0.6% of credit sales will eventually prove uncollectible. So they multiply 0.6% times 400,000 and come up with $2,400 bad debt expense. And they simply debit bad debt expense, $2,400, credit allowance for doubtful accounts, $2,400. Pretty simple. And the thing about the percentage of sales method is at least in practice, it's not real accurate, and I don't know how many companies actually use percentage of sales method. It's probably not a very good method to use because it's just not it's just not real accurate. There's some of these other ways, especially the aging of receivables method is much more exact, if you can even call that exact. I mean, this is not an exact science by any means, but somehow, some way, you have to give it the best estimate possible. I mean, this is more like a quick and dirty method to me, and I would not recommend that a company use it, but it is one of the methods that is available should management so choose. The other thing to note is that regardless of what you have in your allowance for doubtful accounts account at the end of the year, you don't have to make any adjustments when you're determining the amount of bad debt expense to record. Here, you simply figure out the percentage of sales for the year that you believe will be uncollectible and multiply that percentage times the amount of sales for the year. And that's the number that you use in your bad debt expense calculation. And if you didn't quite understand that, you'll understand that hopefully in a second. Percentage of receivables method simply looks at the end of the year, the amount of receivables uncollected, and management determines how much of that balance at the end of the year, uncollected, sitting on their books as accounts receivable, will not be collected, will not be paid. And you simply take the year-end accounts receivable amount and multiply it by whatever that percentage that management thinks will not be collected. Now here, you've got to consider the previous balance in the allowance for doubtful accounts account at the end of the year. And unless it's your first year in business, if it's your first year in business, your previous balance in the allowance account is going to be zero. But if it's not your first year, you will have already, from the previous year, made an adjustment to the allowance for doubtful accounts account. And during the year, and so you have your beginning year balance in your allowance for doubtful accounts account. It'll be a credit balance. And during the year, you'll write off particular subledger accounts receivable accounts as you determine they're not collectible. And at the end of the year, what you're going to have is the beginning balance minus the write-offs during the year. And the result is either a debit balance or a credit balance. You're going to have a debit balance in your allowance for doubtful accounts account when you've actually written off more bad debt accounts than you had in the allowance for doubtful accounts account at the beginning of the year. And so somehow you have to make that up. If you have a credit balance, that means you have written off during the year less than what you started with in your allowance for doubtful accounts account. We'll see that in a minute. But the bottom line is, when it's not your first year, you have to consider the previous balance in the allowance for doubtful accounts account when you're determining the current bad debt expense. Now, this is where my explanation for percentage of sales comes in. With percentage of sales, you don't have to consider the previous balance in the allowance account. Why not? Well, one's based upon revenue, so you're just taking it off of consideration of whatever percentage of revenue is not going to be collectible. Whereas here, the GAAP rationalization by FASB is, well, you're basing this off of a balance sheet account, and thus you've got to consider the previous balance in the allowance account. Doesn't make sense to me either, so if you don't understand it, I'm not sure I do either. But those are the rules. So you got to learn the rules here. All right, so let's look at how that works. All right, so we have Musicland. They have $50,000 in accounts receivable. They have a $200 credit balance in the allowance for doubtful accounts account on the last day of the year. Past experience suggests that 5% of receivables are uncollectible. So 50,000 times 5% is $2,500, and so that's what their balance needs to be in the allowance for doubtful accounts account at the end of the year. Well, they already have $200 in the allowance for doubtful accounts account because they started with $2,200, but they only wrote off $2,000 worth of accounts. leaving them with a credit balance of $200 already before they make their adjusting entry. And so their adjusting entry is going to be the difference between where they want to be, the balance that they want to have in allowance for doubtful accounts, minus what they already have in the account. Here it's a credit balance of 200, so they only need the difference between 2,500 and the 200 that's already there. So they're going to debit bad debt expense for the difference of $2,300, and of course the credit's going to be to the allowance for doubtful accounts account, which makes your ADA account $2,500 after this adjusting entry. Now, the aging of receivables method is much more sophisticated and determines each receivable by how long it's past due. And so you have these aging groups, and if you've ever seen an aged trial balance, as it's called, you're going to have these columns. You're going to have, first of all, you're going to have a listing of all the customers that owe you money from ABC to XYZ. And it's going to have the amounts that they owe you. These amounts are going to be in different columns. And so the columns will be usually the current column. The current column is stuff that just got invoiced and is not due yet. And then you're going to have the 1 to 30 day column, meaning it's 1 to 30 days past due. Then you're going to have a 31 to 60 day column, meaning it's 31 to 60 days past due, and definitely needs some attention, as does the 1 to 30. And then, you know, based upon the company's tastes and you know, how far out they want to, how many columns they want to have, they could have over 60. They could have a 61 to 90 day column if they wanted, and then they could have a 90 to 120 day column if they wanted. It's just however they want to break it down. And you're going to take each column, and there's going to be in your age trial balance a bottom line number for each column. And you're going to take that bottom line number for each column, current 1 to 30, 31 to 60, 61 to 90, and over 90, and you're going to determine the percentage of that amount that you believe will be uncollectible in that next year. And you're going to multiply the bottom line number in each column times the percentage that you believe will be uncollectible in that column. And then you take that sum and add them up for each column to come up with the amount you want to have in your allowance for doubtful accounts account at the end of, well, after you make your adjusting entry. Now, a couple of things here. When you're determining the bad debt percentage for each column, just a fact of life is that the further out a debt gets, the less likelihood you'll actually receive payment for it. So much so that when you get out to the over 90 column, there's I think one study indicates there's like a 95% chance that you will not get paid. And so current, pretty common just to, and again, depending on past history, it's not uncommon for just a small percentage of current receivables to be determined uncollectible. And that number, that percentage number in each column will increase as it goes out. So 1 to 30, a little bit more than current. Let's say current is 2%. 1 to 30 is 5%. 31 to 60 is 10%. 61 to 90 is 25%. And then over 90, pick your number based upon past history. But it could be as much as 95 or 99% or, whatever the company thinks is appropriate. With the aging of receivables method, like the percentage of receivables method, you have to consider what's already in the allowance for doubtful accounts account before your adjustment in determining the amount of bad debt expense. So here we have an example of Musicland and their trial balance of accounts receivable. And notice you've got various accounts in the rows, and then going across in the columns, you have your totals. And so here, current, not due yet, is what they listed. They've determined that only 2% of current is uncollectible, and notice how it's going up in each successive column. And so they take the balance in each column, the bottom line figure in each column, and multiply that times the percent that they deem will be uncollectible in that column, and then you add those figures up. So here you have an estimated uncollectible of $2270, and then you're going to determine what the current balance is in the allowance for doubtful accounts account. Now here it's $200 already, and so the adjusting entry they're going to make is for $2,070 bad debt expense, and of course the corresponding credit is to allowance for doubtful accounts account. Now what happens if, let's say, they wrote off more than what they started with in the allowance for doubtful accounts account, and so they would end up with a debit balance. Let's say they started out with $2,000 in the ADA account and they wrote off $2,500. And keeping with the same example, they would have a debit balance of $500. And so in that case, what they would need to get to $2,270 credit balance is actually $500 plus $2,270, which is $2,770. And so in that case, the bad debt expense would be $2,770, because that gets you to exactly $2,270 in your ADA account. You've got to make up for that writing too many debts off somehow. All right, so here's your summary of methods. And note here down at the bottom, for percentage of sales, just figure out the rate, the percentage of bad debt based upon total sales for the year, and that's going to be your bad debt expense number. Whereas with these other two methods, you've got to consider the balance that's already in the ADA account before you make your adjusting entry. All right, real quick, notes receivable. Promissory notes are written promise to pay a specified amount of money, and there's usually an interest component involved with that. And usually it's at some stated future date, which is called the maturity date. And so this is a real simplified example of a promissory note. You have the maker of the note, that's the one who owes the money. You have the payee, that's the one who's owed the money. And it has the principal amount owed, it has the interest rate involved, and the date of the note, as well as the due date, the maturity date. So we have an example here. On July 10, TechCom received a $1,000 90-day 12% promissory note as a result of a sale to Julia Brown. And so what they figure out is that 90 days from July 10 is October 8th, so that would be your maturity date. And to determine the amount of interest owed or earned, you would simply take the principal amount of the note, multiply it by the annual interest rate, and then unless it's like a full year, you're going to express in fraction terms the fraction of the year involved. And so in our case, in this example, it's 90 divided into 360, or most people who do this use 360 instead of 365 because it's a nice round number. It just makes things easier. And so here you multiply 1,000 times 12%, 0.12, times 1/4 or 90 over 360, which is $30 of interest earned on this note. And so here's an example of how you would record the note receivable. All right, moving on. All right, here we have a situation where on December 16, TechCom accepts a $3,000 60-day 12% note from a customer and granting an extension on a past due amount. When TechCom's accounting period ends on December 31, 15% of interest has accrued on the note. Well, first of all, if they, in this particular situation, they would put on their books the principal amount of $3,000 as a note receivable, and since this is an extension on an already past due amount, they would credit the accounts receivable for $3,000. And the other part of this is, well, the note was written and accepted on December 16. You come up to the end of the fiscal year. Here you've earned 15 days worth of interest revenue. And so you're going to take the $3,000 face value or principal amount, multiply it by the percentage of interest being charged, times the number of days in the year that you earned interest, divided into 360. And so that amount's going to be 15%. And so you're going to make an adjusting entry at the end of the year, noting interest receivable of 15% and crediting 15 to interest revenue. When it's paid in that next year, the amount paid is going to be $30,060, which is going to be $45 of additional interest revenue collected during that next year, plus the interest receivable that was already on the books, as well as the notes receivable that you put on the books in the prior year. You can dispose of receivables prior to receive them a couple of different ways. You can sell the receivables, or you can pledge them. Either way, you're getting money from someone else for your receivables. When you sell the receivables, you sell them to what's called a factor or a factoring company. And depending on how you do this, this no longer is your receivable. Once you sell the receivables, it becomes property of the factor. And so what usually happens is the factor will look at your receivables, take the ones that they believe will be collectible, and charge you a fee for this because you're getting paid early. Now, why would you do this? Well, companies do this to speed up their collections, their cash flow. I would have to say that if you're using a factor, you're probably doing it because you need cash fast. It's because they charge such a hefty fee for doing this. Whereas if you just were diligent in your collection of your receivables, you wouldn't receive the cash as fast, but you would receive more cash because you're not paying the factor fee. When you pledge receivables, you pledge them with a financial institution such as a bank, and the bank loans you money, and the collateral for the loan is your receivables. Not any particular receivables usually, but your overall receivables, and it just becomes kind of a rolling collateral as receivables are collected and more receivables pop up on your books. All right, so that's it for Chapter 7.